Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in plain sight within corporate filings, and I've got a fun one for you today. We're diving into CF Industries Holdings Incorporated's latest report, and let's just say it involves some serious money being borrowed and lent out. Before we jump in, if you love getting these financial insights without all the jargon, make sure you are subscribed. And if you want to hang out with other finance enthusiasts and discuss these reports, join our Discord community. The link is in the description. Alright, so CF Industries Holdings Incorporated, a big player in the fertilizer world, just announced they completed a massive offering of senior notes. Think of it as them borrowing a truckload of money, specifically $1 billion, and promising to pay it back over the next decade with a decent interest rate of 5.3%. This isn't just a small personal loan, this is big corporate financing. Now, the money is technically being borrowed by their direct subsidiary, CF Industries Incorporated, but crucially, the parent company, CF Industries Holdings Incorporated, is fully backing it up. This means the parent company guarantees that this debt will be paid back, putting its own reputation and assets on the line. This is standard practice to make the investment more secure for the lenders. This whole deal was structured through a couple of important legal documents called indentures. Think of an indenture as the contract between the company borrowing the money and the people lending it, outlining all the rules. This specific deal has a main indenture and a supplemental one, which essentially fine-tune the terms of the debt. These agreements come with some strings attached for the company. For instance, they put limits on how much more debt CF Industries can take on, and they restrict the company and its subsidiaries from using their assets as collateral for other loans. They also put limits on certain sale and leaseback deals, which is a way companies can free up cash by selling an asset and then leasing it back. It is all about making sure there are enough safeguards for the bondholders. How did they even get to offer these bonds to the public? It all happened with something called a shelf registration statement. This is like getting pre-approval from the financial regulators to sell securities, like these bonds. Over a period of time, it allows companies to be more agile in raising capital quickly when market conditions are right. And who helped make this happen? A group of underwriters including big names like Goldman Sachs and Company Incorporated, BMO Capital Markets Incorporated, and Citigroup Global Markets Incorporated. They are the ones who buy the bonds from the company and then sell them to investors, taking on some risk themselves, but also earning fees. This agreement lays out all the terms of that sale and purchase process, including promises of accuracy and protection against certain risks. Now, even though this report is about raising new debt, it is filed under the umbrella of CF Industries Holdings Incorporated. This is the ultimate parent company, and its financial health is what underpins this new debt. It is worth remembering that CF Industries Holdings Incorporated stock, which you can trade on the New York Stock Exchange under the ticker symbol CF, is what gives investors ownership in the whole operation. This debt offering doesn't directly change the stock, but it does impact the company's overall financial structure and how much risk is involved in owning its stock. And of course, with big financial transactions like this, you have legal teams involved. Kirkland and LSLP provided opinions on the legality of these issuances, which is a critical step to ensure everything is above board. Now, looking at this filing, what is the big story? It is really about CF Industries financing its future. They're raising a substantial amount of money, and while it is debt, it is a common and often necessary part of corporate growth. The fact that the parent company is fully guaranteeing the debt is a strong signal of confidence from management in their ability to manage this obligation. The key here is to understand why they're raising this money. While this specific filing doesn't detail the exact use of the funds, companies like CF Industries often use debt for capital expenditures, potential acquisitions, or to refinance existing debt at potentially lower interest rates. Given the current economic climate, securing long-term financing at a fixed rate like 5.300% can be a strategic move to lock in borrowing costs before they potentially rise further. The covenants within the indenture, like limiting liens and sale-leaseback transactions, are designed to protect the lenders. This means the company has less flexibility in certain areas, but for the investor, it means a more secure investment. It essentially tells the bondholders that their claim on the company's assets and future earnings is prioritized. So, what is my take on this? CF Industries is essentially taking a measured approach to financing its operations and growth. They are leveraging the debt markets to secure capital, which is a vital tool for any large corporation. The strength of the guarantee from the parent company is a positive indicator of management's commitment and perceived stability. The risks to consider are always there with debt. If the company's core business, the production and sale of fertilizers, were to significantly underperform for an extended period, servicing this debt could become a challenge. However, the fertilizer industry is cyclical and tied to agriculture, which has its own long-term demand drivers. The opportunity here is that with this financing, CF Industries can continue to invest in its infrastructure, potentially expand its production capacity, or pursue strategic initiatives that could drive future profitability. In conclusion, this filing shows CF Industries Holdings Incorporated is actively managing its capital structure. They've successfully raised a significant amount of money, and while it is debt, it appears to be a well-structured and well-supported move. We'll be watching closely to see how they deploy these funds and how it impacts their long-term performance. Alright, that is our breakdown of CF Industries Holdings Incorporated's latest filing. What is your take on this debt issuance and what it signals for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.